All right. Today is Thursday, the 27th of April. Welcome to another economic discussion. And folks, I got a good one for you tonight. We'll give you an update on the banking crisis and why things are about to get even worse, unfortunately. And the story begins when the inflation problem in the U.S. economy became evidently clear. Yet the Federal Reserve continued to dismiss the inflation problem as transitory, until of course inflation became embedded in the U.S. economy, finally prompting a response by the Federal Reserve. And they started tightening the monetary policy, but they were catching up from behind. They were too late to the game, and there was a lot of catching up to do. So the Fed used the most important tool in tightening the monetary policy, raising interest rates aggressively.
We will use our policy tools as appropriate to prevent higher inflation from becoming entrenched, while promoting a sustainable expansion and a strong labor market. Our monetary policy has been adapting to the evolving economic environment, and it will continue to do so. We've phased out our net asset purchases. With inflation well above 2% and a strong labor market, we expect it will be appropriate to raise the target range for the federal funds rate at our meeting later this month.
We knew from past episodes in the 1970s and 1980s that to defeat inflation, the Federal Reserve funds rate must increase above the inflation rate. So there was a lot of ground to be made up, because interest rates at the time were pretty much at zero, while the inflation rate, at least the official one, was heading to 9%. And the problem is, the U.S. economy for years has been conditioned under quantitative easing in the aftermath of the great financial crisis in 2009, the easy money era, with zero interest rates and no cost at all for borrowing money. We enjoyed an economic boom. So when the Fed raised rates aggressively and abruptly, from zero all the way to tackle the inflation rate, we knew that this will cause a lot of economic shocks. It's not just raising interest rates from zero to positive. Other shocks included how businesses and consumers start to shift their psychology after being conditioned for over a decade on the quantitative easy money era. Lots of business decisions have been made in those years, among them accumulating an insane amount of debt, not just for the federal government, but among businesses and consumers. In the quantitative easing era, when the Fed was buying bonds and thus reducing the interest rates down, many businesses, including banks, decided to follow the same playbook. If the Fed is buying bonds, we're going to buy bonds too. The problem is, with buying bonds comes the obligation of holding these bonds until maturity. So raising rates all of a sudden creates a lot of shocks along the way of the economy. We knew ahead of time that the transition from quantitative easing to quantitative tightening and effectively ending the easy money era to defeat inflation will not happen amicably. And there will be plenty of disasters and plenty of victims along the way. We got a little taste with the collapse of Silicon Valley Bank, but that was just the beginning. One domino to fall, but there will be more to come. We're already seeing them. So let's talk about it, folks, and here it is. In focus tonight. An end of an era. We're now seeing the consequences. You might be aware that in the aftermath of the collapse of Silicon Valley Bank, the Federal Reserve, the FDIC, and the Treasury Department all came together to prevent a contagion impact from the collapse of Silicon Valley Bank. And the plan they came up with is extending lending facilities to these banks. In essence, if any bank is sitting on losses on any assets they're holding till maturity in their balance sheets, the Fed will extend loans to this particular bank on the par value of that asset, not the current value. In other words, the Fed will make the assets of these banks whole again. And the goal was for the banks to use these lending facilities to counter any bank runs. If consumers decide to take their money away and move their deposits out of a certain bank, we're not going to see another episode of the Silicon Valley collapse, because whatever deposits get out of a certain bank, they can go to the Fed and say, look, we're losing some deposits and we need to borrow whatever billions of dollars to make up for that. And we thought that this will be enough to mitigate the crisis. But now we're getting information that this will not be enough, and it will not prevent bank collapses from happening from this point on. This week, we learned that First Republic Bank lost 40% of its deposits in the last quarter. We don't know if this is getting better now or getting worse, but all indicators are saying it is getting worse. Over $100 billion worth of deposits exited the bank. This comes after all the lending facilities by the Fed and rescue plans by other larger financial institutions led by JP Morgan Chase and CEO Jamie Dimon. Initially, when banks extended all of these rescue plans to First Republic Bank, it restored some credibility and some faith that perhaps FRC, First Republic Bank, will make it. We saw retail investors, the mom and pop, pouring hundreds of millions of dollars, buying shares of FRC, betting that the bank will make it. Unfortunately, this week alone, FRC, First Republic Bank, lost over 50% of its equity value, meaning a lot of these mom and pops investors lost a lot of money. And it appears that the bank is on the cusp of collapsing. And this problem is not just limited to FRC. Many banks are facing the same problem, including larger institutions. For example, we learned that Bank of America is sitting on $99 billion worth of unrealized bond losses. But of course, the CEO of BofA, while he sees a recession coming, is not worried at all. How could he? He's set for life. The guy's a millionaire. But is he worried about the state of the economy, the American consumer, the middle class, or even his own bank? And it's not just BofA. U.S. banks are sitting on $1.7 trillion in unrealized losses. And they say that's not a problem until it is. Well, maybe this time is right now. This time is coming. You see, back in the quantitative easing era, initiated by the Fed in the aftermath of the great financial crisis in 2009 to rescue banks and the assets of the wealthy, stocks and real estate, but not the middle class, not the lower class. Part of the quantitative easing program was the Fed buying bonds, U.S. Treasury bonds, and a lot of institutions, be it corporations or specifically banks, once again, if the Fed is buying, we're buying too. It's a no-brainer. And of course, we know that bond prices have an inverse relationship with yields. If prices go up, yields go down. This is the essence of the quantitative easing program. The Fed buys bonds, reducing yields on those bonds to make equities and real estate and other investments more attractive than U.S. Treasury bonds. But in doing so, they push the prices of these bonds higher. So the bank said, okay, we'll go with the Fed, we'll buy these bonds and hold them until maturity. We'll buy these mortgage-backed assets all the way till maturity. But then came inflation. And to tackle inflation down, the Fed had to raise rates higher. In doing so, they have to get rid of bonds. Bond prices go down, yields go higher. But what happens if you bought all of these bonds for all of these years and you've been holding them for 2, 3, 10, 15 years and they still have plenty of room till maturity? Well, now you're sitting on massive losses as the Fed continues to raise rates, driving prices of bonds lower. If you're a bank and you're in this situation, you got a choice. Either to sell these bonds at a loss and get out, which could be disastrous, or you cross your fingers and you hope that you're not going to need a lot of money right now. You're not going to run into a liquidity event, such as a bank run, when your customers want to take their money out, or they want you to pay them a higher interest rate. But this is the situation that we're already in. Depositors look around and they say, wait a minute here. My bank is only paying me 0.5 percentage point, 1% at most on my savings at the bank. I can move all of that money and put it in a treasury bond or a bill that pays me 3, 4, 5% or a money market fund. Why would I keep my money at the bank? And customers started taking their money out. Well, now the question is, hey Maverick, why don't the bank just pay higher interest rates on the deposits? The answer is they can't. A lot of them cannot afford it. If they pay depositors 2, 3, 4, 5%, they're going to go bust. On the other hand, if they have a bank run, they're also going to go bust. So now the facility by the Federal Reserve, the lending facility, is the only thing holding these banks from collapsing, as depositors continue to take their money out of banks and depositing them in money market funds or treasury bonds instead. But rest assured, maybe the solution is coming. Maybe this story is not going to end in a tragic way. This is at least according to JP Morgan CEO Jamie Dimon, who says that we are near the end of the banking crisis. But are we? The answer is not even close. It's about to get worse. You know why? The crisis will be over if the Fed stops raising rates, but most importantly, starts to cut rates. Then banks don't have to compete with treasury bonds or money market funds anymore, and they don't have to pay depositors anymore. Interest rate. Well, why wouldn't the Fed just cut rates right now then? The answer is inflation. And if the inflation problem is subsiding, then good, we're getting closer. crisis averted. But if inflation is not going down, if inflation remains sticky and requires the Fed to increase rates even more, then this banking crisis will get a lot worse. What did we get today? We got GDP data. While the GDP itself went down, a disappointment, the inflation reading, the PCE price index within the GDP report, was actually higher quarter over quarter. So we saw a rebound in inflation. In other words, we have a stagflation problem in the economy, an economy that is slowing down while the inflation problem is still here. And if that is the case, can the Fed really pause or cut interest rates while inflation is still going on? The answer is no. But the consequence of that is more banks will blow up. So the Fed has a choice. Let more banks blow up or pause and start cutting interest rates to save banks, but allow the inflation problem to get even worse. A horrific choice that the Fed and we as a country have right now. And of course, we thought that the worst is behind us. The Fed extended lending facilities. Banks took these loans to cover for any bank runs, and it appeared that the bank run problem is getting a lot better. We're not seeing massive exodus of deposits, and we breathed a sigh of relief. But now we're getting the information that we're seeing more exodus from depositors out of these banks, and all of a sudden they have to borrow more from the Fed Emergency Loans Facility. Now, unfortunately, a lot of viewers have the misconception that this is quantitative easing again, that the Fed is giving banks all of this money and they're going to write loans using this money, and this will be stimulative to the economy. On the contrary, this is a rescue plan. The bank is borrowing money to cover for lost deposits, to have the cushion to withstand any more losses of deposits, not to extend loans. But this is a band-aid. If the bank runs continue because depositors are looking for better rates elsewhere, this solution will fail, which means that sure, we're going to see a lot of banks blowing up, but what about the big ones? They have to take things in their own hands now. They can no longer rely on the prospect of the Fed cutting rates anymore because the inflation problem is still here, which means we're going to see more and more exodus of deposits. So what do? They have to tighten lending conditions dramatically. When banks take matters in their hands, the only solution is to become extremely conservative. No room for risk or extending loans anymore. And we're already seeing this happening in the economy. The headline reads, lending to consumers has dropped as banks move quickly to further tighten credit standards after failure of SVB, according to the Fed survey. What are they talking about? An index tracking overall loan volume fell to minus 18.3 in the survey conducted March 21st through the 29th, to which 71 financial institutions responded. The index was at 4.8 in February. The largest drop among loan types was consumer loans. That index fell to minus 33.4 from minus 17.8. You can see it right here. Loan volume is collapsing. And listen to this. At the same time, a gauge of credit and lending standards indicated lenders such as banks and credit unions further tighten access to funding. The index fell to minus 35.9 from minus 29.8 in February. Unbelievable. And you can see that bank lending fell to a record, the biggest drop in history, by $104.7 billion in the last 2 weeks of last month. The headline reads, the credit crunch has started. Here's what tighter lending standards mean for American consumers and businesses as banks navigate the SVB wreckage. Nearly 45% of banks made it more difficult for businesses to obtain commercial and industrial loans in the fourth quarter of 22, according to the Fed's survey of senior loan officers. The $2.8 trillion C&I loan market helps businesses buy equipment and hire staff, among other uses. Requiring higher minimum credit scores and minimum repayments and curbing credit limits were among tweaks banks were making. That tightening was happening before, listen to this, before the blow-up of Silicon Valley Bank and Signature Bank kickstarted a run of at least $500 billion in deposits out of small and mid-sized banks. With lending a vital part of economic growth, investors are watching to see how risk-averse banks and other lenders will become. Banks have two key concerns, Brett House, a professor of professional practice in economics at Columbia Business School, told Insider. The first is if borrowers facing higher interest rates can afford to repay and service their loans. The second is centered on the bank's own ability to maintain liquidity so that if depositors pull their money, they have the cash to meet those demands. In other words, the banks will have to be more and more conservative. No more new loans. We got to worry about the loans that we have right now. We got to worry about whether our customers can repay the loans or not. We got to worry about if our consumers or depositors are going to take more money out of the bank or not. But what does that do? The tightening of lending conditions. It leads to a massive economic slowdown. Economists are now watching for the after effects of recent bank collapses across many industries. How bad could it get? Here's what we know, folks, and you got to pay attention now. The consumer is already getting wrecked by this inflation. After-tax wages are collapsing. All of the pandemic boom that we've enjoyed, wages are now growing at only less than 2%. The official inflation rate is at 5%, if you even believe that. Some would argue that the real inflation rate is north of 8% right now. It is certainly above 8% in certain categories. And when we break it down by income, middle class, lower class, higher class, everybody's seeing a massive slowdown in wage growth. Those earning more than $125,000 a year are actually seeing negative wage growth. So if the consumer is now facing higher inflation in utility bills at the grocery store for buying goods and services, and their wages are falling behind because their wages are growing at less than 2%, the inflation rate is above 5%, what do? They have to resort to using their savings. Well, the problem is they've already exhausted their savings. So what happens if savings is a no-go because you've exhausted all of your savings? Well, now you have to resort to using credit card debt. And shockingly, U.S. credit card debt jumped by 18.5%, heading a record of almost $1 trillion. And the most disturbing fact is, a lot of folks are using credit card debt to pay for grocery bills. Food has become too expensive. Households have to use credit cards, and others have to use buy now, pay later services for food. This is happening in America, ladies and gentlemen, right now. And the question is, what if the consumer is already heading toward maxing their credit cards? Take a look.
Now to a brewing debt crisis in our country, Americans owe a record amount on their credit cards as inflation makes it hard for many to pay off their balances. Chief Economics Correspondent Rebecca Jarvis has the story. Good morning, Rebecca.
Hi, George. Good morning. And we've seen this explosion in debt overall. Credit card balances especially have hit a new record at the end of last year, nearly $1 trillion. That's not only the highest ever, according to the Federal Reserve Bank of New York. It was also the biggest yearly increase on record, up $130 billion. So what is driving this jump? Well, it shouldn't be a big surprise to anyone out there. Inflation and rising interest rates are the two big culprits. You pay more at the grocery store, your credit card bills go up, and then at the same time, the Fed is hiking interest rates to eventually push prices lower. But in the meantime, you owe more on your credit card bill. And in real terms, the average household is now carrying about $6,500 in credit card debt with an average APR of 20%. That is the highest in almost 4 decades. And what is troubling now is that credit card delinquencies, that's people who are 90 days behind on their payments, those are also going up, and they are now higher than they were pre-pandemic, especially, George, among younger borrowers.
$6,500, that's a lot higher than I thought. Well,
as the debt soars and interest rates rise higher, the consumer is getting squeezed on that debt. And now we see that more U.S. consumers are falling behind on payments, be it credit cards, be it auto loans, mortgages. And you might say, hey, Maverick, but what about tax refunds? Maybe that will be the savior and add a little bit of cushion, much needed cushion to the consumer. The answer is, the tax refunds, they're not really that good. For those earning less than 50 grand, tax refunds were down by 8%. So the consumer has to learn what banks are learning. If you're getting squeezed from all directions, you gotta take things in your own hand. And the only thing you can do right now is tightening the belt, which means you're not gonna spend more. You're not gonna use credit card debt anymore. You're gonna accept living at a lower standard. And this is already happening. The headline reads, according to Bloomberg, U.S. credit and debit card spending slows to the weakest pace in 2 years, BofA says. You can see it right here. Credit and debit card spending per household is about to go negative. Consumers are using credit cards and debit cards less on retail businesses. No wonder why we're seeing a lot of retail stores closing right now. They're using their credit cards and debit cards less on dining in restaurants, on services, on everything. And as the consumer dials back, because they have no other choice, how will the economy be stimulated? How will small businesses make revenue? How will companies increase their earnings if the consumer is slowing down and not spending anymore? Well, the end result is a lot of businesses will have more expenses than revenues. They have to shut down. physical businesses, small businesses. And as they shut down, they have to lay off employees. That creates more and more weakness in the economy. As the consumer tightens on spending, they stop using the credit cards anymore, corporate earnings will go down, which means the stock market will go down. That diminishes the wealth impact in the economy and creates less and less spending and less stimulation in the economy. In other words, it means a recession. And the wild card is, many assume that the recession will solve the inflation problem, and this will allow the Fed to have the tools to re-stimulate the economy and create another boom cycle. But the wild card is, what if commodities inflation sticks for whatever reason? Let's say energy prices sticking higher while the economy is wrecked. We still see higher food and energy prices. That would be the nightmare scenario. Folks, let's hope this doesn't happen, but this is the reality in this economy. And if you didn't know, now you know. And with that, folks, we have reached the conclusion of this video. Hope you enjoyed it and you find it informative. If you did, return the favor by subscribing, pressing the like button, and the notification bell. But with that, folks, this is all I got for you for now. Once again, thank you for listening, thank you for watching, and I will talk to you again tomorrow. Take care.
I urinate in public. So do I.